Last week, we spoke about options basics. What's a call, what's a put, and what is an option in general. However, this week, we're going to dive a little more in depth. There's a common misconception with how you profit on an option. A lot of times people get confused, they don't do enough research, they don't look into it, and they go blindly into the options market without knowing anything, and it can lead to some really bad and dangerous repercussions. In this video, we're going to go behind the math that comes with the options contract. How you know whether you're in the profit, whether you're in the red or whether you're in the green. I want to start off by saying though, this is not a video for someone who is just looking to trade options contracts. Those contracts will move with the supply and the demand of the market, just like a stock. Rather, this video is for someone who is looking to maybe in the future exercise one of their options contracts that they hold. So let's go over a quick review on what we talked about last week. Last week, we went over the minimum of what an option is. An option is the investor's right, but not the obligation, to buy or sell a stock at a future price and date. A call option gives the investor the right to buy a stock at a specific price on a specific date in the future. Whereas a put option gives the individual the opposite, the right to sell a stock at a specific price at a specific date. Now, when you buy an options contract, you must pay what's called a premium. And what that is that's your payment for the right to go buy that stock at a future time. So for example, let's say I'm buying a option contract for $2 on a stock that is currently at $20 and the strike price is $25. My overall cost basis, if it ever hits $25, will be $27 due to the fact that I had to pay the $2 premium in order to exercise that option. And that's where this math comes into play. I'm going to take out the whiteboard and let's go over it. So as you can see right here, we have our two basic options contracts. We have the call and we have the put. Now for your call option, let's say you buy your contract at $20. The stock is priced at $20 and you pay a $2 premium for the contract. Your strike price is $22, meaning that you cannot break even until for exercising. I want to reiterate this, that this is strictly for people looking to exercise their options contract. You cannot break even until this 24 mark. 24 is when your profit begins. Now, why is this? Because if you're going to exercise the contract, yeah, you can exercise it at 22 directly, but you've still paid $2 in premium for it in addition, and that's going directly in your cost basis. So instead of your cost basis being for 100 shares at 2200, it's going to be 2400 because you paid that $200 for that $2 options contract. And the reverse is with the put. A put, let's say you're at 24, you buy a $22 put at $2, you can't start breaking even and making profit until 20. And this is what makes options contracts so confusing to some people, is they think, oh, once the stock hits 22, I'm golden. My strike is at 22. Once that stock hits 22, I'm in the green and I'm going to make buku bucks. But that's just not the case. You have to take into play your premium cost. The premium is the most important thing in an option. That's why when you buy an option, you should look at the premium and make sure it makes sense for the stock. You're not going to buy a low volume stock option for a $22 strike for a premium of $5. It's not going to go $5 over 22 if it's a low volume security. You got to take into account all of these aspects when trading in the options field. It's a dangerous field. It is very confusing to a lot of people. That premium is what will make or break you. A high premium makes it harder to earn money. A low premium makes it easier. And that's why as the stock inches closer, the premium will be more expensive. A premium for a $22 strike price on an option will be a lot more expensive if the underlying stock is at $21.50 than if the underlying stock was at $15. We call those lottos. If the underlying stock is a good while away from the strike price and you buy the option contract for the strike price, that's called a lottery ticket. That is gambling. That is not anything else. You are expecting a big move in volatility, which we will go into in the next video when we talk about options trading strategies. However, when you're looking to exercise an option, you should look to get into an option contract that makes sense for you, that makes sense for the trade based on the technical and fundamental indicators. And always remember, the strike price is not your break-even point. It's the strike price plus the premium you paid for the security that is your break-even point. Thank you guys for watching. Next week, we will go into more option strategies. However, until then, please check me out on Instagram and Twitter. Instagram is Parker_Friedman3 and Twitter is @TheNotoriousPF3. And then in the link of both of those bios is the link to my podcast, The Trending Ticker, a daily financial news podcast where we go over the happenings in the market. And I'm happy to announce that next Sunday, for the first time ever, the Trending Ticker will be hosting its Sunday Conversations podcast. And we will be having former NFL tight end and real estate investor Hakeem Valls on the show. We are very excited to have him on, and I hope you all can join us in listening. But until next Saturday, where we go over options contracts, stay safe and stay investing.